the pandemic was obviously a public health catastrophe, and it essentially came out of nowhere. The U.S. economy was in a very good place in January of 2020, and then within 2 months, by March, it's sort of like the asteroid hits the Earth, right? So 22 million people lost their jobs in 2 months. GDP collapsed at a 30% annual pace. And you're thinking as a policymaker, how do you run a financial system if companies don't have revenues coming in? They can't pay workers, they can't make coupon payments, through no fault of their own. There weren't any obvious excesses. It was literally an exogenous shock. The mitigation efforts put in place to contain the virus obviously hit the economy. So it was all hands on deck. Now, the specific focus here is there were things that the Fed could do using conventional tools like cut rates, buy a lot of bonds. And we tried that on Sunday, March 15th, 2020. And then at that point, really under Jay's leadership, we then moved into both providing liquidity to markets. We relaunched some programs that the Bernanke Fed had rolled out in the global financial crisis. It was actually quite convenient because there was no learning curve. But John, the actions you referred to were the decisions that we made, that we rolled out on Monday, March 23rd, in which, and I vividly remember the conversation with the other officials and with Jay Powell about, in my perspective, breaking the glass in the sense of saying that we were standing in to backstop the entire investment grade corporate bond market and the municipal bond market, and also would try to work with other authorities in terms of bank lending. There was a lot that went on behind the scenes. Those were all board decisions. So within the Fed's organizational structure, monetary policy, raising or lowering rates, is the Federal Open Market Committee. But these liquidity programs and backstopping the markets are really programs that the Fed has to invoke something. Normally, the Fed can't backstop the corporate bond market or the municipal bond market. It has to invoke a statutory language. Section 13.3 of the Federal Reserve Act, as amended in 1935, says that the Fed, under unusual and exigent circumstances, those are the exact words, can essentially lend any amount of money to anybody so long as the Fed expects to be paid back. So we invoke that authority. The final thing I'll say is behind the scenes efforts with Congress, with bipartisan support. The CARES Act passed also that week of March 23rd. It was $2.5 trillion of support for the economy. And in particular, the CARES Act appropriated $450 billion to the Treasury Secretary to co-invest in Fed facilities that we calculated we could lever up 8 or 10 to 1. So I think the headline number that week of March 23rd is the Fed has $4.5 trillion of firepower to backstop the capital markets, which we did. In the end, we actually didn't really need to use very much of it because confidence returned. So that's the quick version of a very eventful 10 days.
Well, the way I look at it a little bit is that in addition to your conventional tools, which is controlling the interest rate, the riskless interest rate, you managed to restore confidence, you call it, in many other markets, lending markets, where the rates are much higher than the riskless rate. You brought them down. You lowered effectively lots of rates, not just the riskless rate. And so my question is, the paradigm question is, if this works so well and is so important in a crisis, why don't you think about it in normal times? I mean, most lending is not at the riskless rate. Most borrowers are not paying the riskless rate. Why doesn't the Fed talk about non-riskless rates? And why doesn't it even target non-riskless rates in normal times?
I think there's a distinction certainly that I would continue to make if I were still there. I think in the Fed's thinking, credit spreads are processing information about default risk and prospects. And the Fed and I would have felt very uncomfortable as a routine manner targeting credit spreads. But the Fed is very aware that policy is transmitted through credit markets, through credit spreads, mortgage spreads, and the Fed's thinking is it wants the market to be well functioning enough to evaluate that risk, but under duress, as in the global financial crisis or the pandemic collapse, you do temporarily step in to essentially backstop the credit markets. But I would certainly think it would not be a good idea for the Fed to be routinely in the business of targeting or looking at credit spreads as the instrument of policy. We do want markets to function, to allocate risk, I think.